In this presentation, we will enter a reversing entry related to unearned revenue within QuickBooks Pro 2019. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Here we are in the home page. We currently have the open windows open. In order to open the open windows, you go to the view drop down up top and select the open windows list. We're going to go to a reversing entry. So first, let's take a look at the financial statements. In order to do a reversing entry, we want to first know what the adjusting entry was related to unearned revenue, why we did it, and then how we would reverse it. So we're going to go to the reports up top. We're going to go to the company and financial and scroll down to the balance sheet. Within the balance sheet, we're going to change the date range up top in the customized reports area. We will customize the reports and change the report dates from 01/01/19 to 02/28/19. This is not 09, but 19. That's the dates we're working on. This is our cutoff date when we did the adjusting entries, which would be February 28th. So we're going to say OK. Now what we have here is an adjusting entry for unearned revenue. Now it's a little bit different the way we are doing the unearned revenue here than you might see in a textbook. The textbook is going to give you unearned in either case, you'll have unearned revenue here. The question then is, how did that unearned revenue get there? What is the accounting department normally doing whenever we do any of these adjusting entries? And how can I make it as easy as possible on the accounting department? How can we make our adjusting entries as non-intrusive as possible in anything that the accounting department normally does? That's going to be our goal. So we want to keep the two things kind of separate, whether we do both things or not. And especially so if we don't do both things, we want to be able to say the data input for the month is what goes on during the month. And if they have to do anything to make that more standard or systemized, then and we can take care of anything at the end of the month with adjusting entries to make the financials correct on a periodic basis as we make the financial statements. Then that's what the adjusting entries will do, and we can then do the reversing entries to separate those two processes so that our adjustments don't mess anything up just for the normal accounting process. So what in terms of the unearned revenue, the question is, well then how did this unearned revenue get there? If you're talking about a book problem, most of the times we will enter unearned revenue when we enter get the cash. In other words, we get the cash, we would debit cash, and we would credit unearned revenue in a situation where we had not yet done the work. In our situation, we're saying that we sell guitars. We got a deposit for the guitar before we delivered the guitar, and therefore we have debited cash, but we can't credit revenue because we did not yet earn the revenue until we deliver the guitar. So we should then put it into unearned revenue. And then so typically in a book problem, the adjusting entry would be to then go into unearned revenue and figure out how much of that unearned revenue had been earned. In practice, you'll often see a different type of issue with the unearned revenue, and it's possibly the case that the company's not recording the unearned revenue in that fashion as you would typically see it in a book problem. And there's a reason for that logistically, and that would be that it's easier for us to track the unearned revenue or the deposit in the customer field because we want to be able to track it by customer. So to do that then, if we go back to the home page just to review, we're going to say that what has happened here is the practice that we have during the business is to record deposits with the receive payment item here, which will, whenever we do this, it will debit unearned or undeposited funds, cash, and it will credit the accounts receivable. And it will do so even if, in this case, we don't have an invoice for it. And what that'll mean is it'll give us a credit balance to that particular customer, which is fine for us within QuickBooks because then we can then apply it out to the invoice or create sales receipt when we make it in the future. So we're just doing things in kind of a reverse order, but by using these same icons, these same data inputs, we will then be tracking it within the customer's account and the customer reports, which is beneficial. So it's beneficial to do that. And let's see what would happen in terms of the reports up top. We'll go to the reports. We'll go to the customers and receivables, and we want to take a look at the customer balance detail. Now this customer balance detail will match the balance sheet for the receivable. So we went back to the open windows. Here's the receivable, $11,274. If we go to the customer balance detail then, and scroll down to the bottom, this is $11,274. The one we're concerned about, the adjusting entry we had here, this is a journal entry you can see here. This adjusting entry was for the string music. And what it did is we had a $3,300 credit balance or negative balance in it. And we just basically zeroed that out to make it zero. In other words, before we had this adjusting entry, we had this negative balance in the receivable, which isn't quite proper. It's not quite proper reporting. What we should have is nothing. This shouldn't be in the receivable. It should be not a negative receivable, but a positive liability. And that's the adjustment we did. We made it, okay, we took it out here and we made it a positive liability. Let's go back to the balance sheet to see that here. If we go into just the balance sheet, we see that the accounts receivable, as of the end of the time period, we had this adjusting entry increasing by 300 because that one client was representing that we owed them money in the receivable account. And that's not what it should be. If we owe them, it's not an asset, it's a liability. It's not a negative asset, it's a liability. So we increased the receivable. If we close this back out, we made an unearned revenue here. Double clicking here, here's our other side to the journal entry. The unearned revenue representing it's a liability. This is how we should be reporting it if we're giving this information to outside users of it. We didn't originally put it into unearned revenue because then this account's not supported by the subsidiary ledgers. So it's more difficult for us to match up the receipt in the sales receipt and invoice. So this has been done now for reporting purposes as of our cutoff date. What we want to do now is reverse it so that we can get back to just the normal system, which works logistically within the company. So as of the first day of the next time period, we want to get this back to where it was. Meaning, if I go to this customers, I want this shown to be a negative receivable, because a negative receivable will allow the system to then say, when we make an invoice or sales receipt, hey, do you want to apply this credit to it? It's in the system because it's being tracked by this customer. The customers are tracked by account type, accounts receivable. And so we want to have that credit balance in there so that we can match it out. So what we're going to do then is say, okay, we made this correct as of the end of the time period so that we can report our financial statements on an accrual basis. And now we're just going to make a reversing entry so we don't mess up the normal accounting process. So there's two objectives when we do the adjusting entry. One, we want to make the financial statements correct. But two, we want to make it as smooth a process as possible for the people we're working with, the bookkeeping department, or ourselves, if we're doing both things here, to make the two things as easy as possible. So to do that, we will reverse this as of the first day of the next time period, which will be March. So what we're going to do then, we've got the accounts receivable. What we did is we increased the accounts receivable and we increased the unearned revenue. So we're just going to reverse that now. To do that, normally we would do a journal entry, go into the companies up top and going down to make journal entry. And we would make it as of the first day of the next time period, so March 1st. And we would then debit the unearned revenue, making it go down, and credit the accounts receivable, making it go down. But we're going to try to do this with the ledger again, to try not to use the debits and credits, but the ledger, which we can do if there's not too many accounts. We will see this ledger account and go back to it because QuickBooks will make the journal entry for it as we use the ledgers. Closing this back out, we can go to the banking and we can go to use register. One way we can find these registers, and then we could find the register we're looking at. Now, we could go to accounts receivable, but because accounts receivable is kind of a special account, it's easier to go to the other one, the unearned revenue, which is also a balance sheet account. So either register should work, but this unearned revenue will be kind of more of a plain type of account. So it might be an easier register. Accounts receivable has some special characteristics to it within QuickBooks. So if we close this back out, the other way we can find it is go to lists up top, chart of accounts, and we're going to go to the unearned revenue. So here it is, unearned revenue. Double clicking on that item. We're going to make it for the first day of the next time period, which is March 1st, 2019. We don't need any payee, and all we're going to do is say it went up last time, and we're just going to reverse that exactly. So we're going to decrease it this time. And it's the other side's going to be, it was to accounts receivable last time, it will be to accounts receivable again. It's just going to be going the other way this time. We can find accounts receivable by selecting the drop down, or we can just start typing in accounts receivable. Make sure you pick up the receivable and not the payable, like I do every once in a while. Accounts receivable. I deleted accounts receivable tab. And then we're going to say this is a reversing entry for unearned revenue. Something like that. And then once we say enter, it's not going to let us record it again, I think, because we're doing something to accounts receivable. So let's try it. And it's going to say, please choose a customer when using accounts receivable. So notice it's not letting us mess up our sub account by doing that. And so it could be frustrating, but that's a good thing. It's trying to help us out there. We don't see any customer field here, however. So how can we do that? We can go to the split item down here. And we see there's the 300. Now we're going to copy this same text and put that in the memo. And so there we have the other side there. And that should, and then we need the customer. And if we go back to the chart of accounts, we delete it. Let's go back up to reports. Go back to customers and receivables and customer balance detail. All right. We're going back to this 300. It's string music is who we're looking for. So then we'll go to our unearned revenue in the open windows. And we're going to say string music, which we could select the drop down and find here, or just type in string music. And there we have it. So we'll go record. It is a journal entry. So you can see it's a journal entry here. Double clicking on that. So this is, QuickBooks has no other form to drive this. It is just a journal entry, even though we're entering into a register. And it's going to be a debit to unearned revenue, a credit to the accounts receivable. So let's close this and go back to our balance sheet and see if it does what we would expect it to do. If we go to the accounts receivable and double click on that item now, it's not there as of this date, but if we change the date to one more up to the next time period, there's the 300. So here's the cutoff that we had, right? Here's the cutoff. We entered the 300 increase in it, and then we reversed it, decreasing it, putting us back to where we originally were. The balance then is 10,449. If we go to our customer balance detail and we refresh this, we should be at the 10,970. So here it is, 10,974. If we go back to the balance sheet as of one day up, 10,449. Well, let's change the date here. The ending date, it should going to be 03/01/19. We're off by a little bit. There it is, 10,449. And there's one, the reason that it was off a little bit is because there's one other transaction that happened in the current period. So it defaulted to a later time period, and there was another transaction. So it's just a date issue. 10,449. If we go back to the balance sheet, we've got the 10,449. And then going back to the customer balance detail again, we can see that this is what happened here. It looks a little confusing, but it puts us back to where we originally were. We had 300 credit, so a negative 300 that we owe back to string music. And then we reversed it as of our cutoff date. And so we're correct as of the cutoff date. And then we put it back there so that we can work, the bookkeeper can do what they originally were going to do, applying the credit out, and we haven't messed anything up or changed the normal system, normal operations that will take place. If we go back to the balance sheet, we're going to see that if we go to one day back, we had this unearned revenue account. If we double click on it and go one day forward again, so now we're going to 3/1. So here's our cutoff date, one day forward. Then we see that here's our adjustment, here's our reversal of it. So we made it correct as of the cutoff date, and then we took it back down to 0. For more accounting information and accounting courses, visit our website at accountinginstruction.info.